You're most welcome, ladies and gentlemen, to today's call. Just make sure you share the link. We are about to get started. Our guest speaker from Ghana is already on the call. So share the link. We don't want to waste time. If you can hear me, drop a one in the chat. Drop a one in the chat. If you can hear me, drop a one in the chat. Just to confirm that I'm loud and clear. So with us today, we have different coaches on the call. Happy to see you, Coach Manish, all the way from India. Happy to see you, my brother Derek. So, okay. All right. So we are starting very soon in a few minutes. Okay. Right. Leader Emma, could you take over right away? Leader Emma, could you take over? All right.
All right. So good evening to you all once again. We are starting right away. So try and share the link to your friends, your downlines, and your team members to join so that we can start. We're not going to waste my time. Your leader said, we're not going to waste my time here. So try and send the link to your team members, your downlines, and let them join so that we, yes, within the next few minutes, we are starting. Share the link. Share the link. Okay, so I'm sure you cannot hear me, right? Can you all hear me? If you can hear me in the chat, give me one in the chat if you can hear me. Give me one in the chat if you can hear me. Meanwhile, share the link with your friends. If you can hear me, give me one in the chat. It seems I don't can't hear me. Okay. All right. So we are starting right away. We're not wasting my time. We began an interesting session on the futures market, and I think we started last week. And along the holiday, we paused to enjoy the Easter break. And so far, so good. We are continuing from where we ended. And it is important for you to know that trading is not difficult, okay? Provided you will be willing or you will learn all the time, you would really understand that trading is not difficult. And whatever you're anticipating to get, if you dedicate your time to learn, you will be able to get. So over time, we've been trading on the sports markets and we've experienced the knowledge and the profits on the sports markets. You've seen how the sports market that's what works, right? So for some days now, we've been also discussing more about the futures markets, and some of you have already started trading on the futures market and you are experiencing the futures market. So we would have to continue the session, and I believe in one thing, that there is power in repetition, there is power in consistency. So the more we keep learning, the more we keep repeating the process and then expanding the horizon of knowledge, it will help more people to understand the concepts and then also engage themselves in whatever knowledge we are sharing or practice whatever knowledge we are sharing. Right? Good. So without wasting my time, I'll share my screen for us to proceed. But before we do that, are you sharing the link? Share the link to your friends. Share the link to your downlines. This is for activated members. So share the link to your team members so that they join us. Okay. Share the link to your team members so that they join us. Share the link to your team members so that they join us. Okay, so let me share my screen. Sure. Okay. So I'm sure my screen is visible now, and you can see. I'm sure my screen is visible now, and you can see it, right? I'm sure my screen is visible now, and you can see my screen. Can you see my screen? Can you see my screen? All right. Okay. So let's start. Like I said, we are not going to waste my time. Yeah. Good. Good. So I think my screen is visible, and let's quickly go to the board. Now, we've discussed about the futures market, just like I said last week, and we've got more understanding, more knowledge of futures markets. And we said when we talk of the futures market based on contract. It's a contract market. And the reason why we are saying that the futures market is a contract market is that from the idea that we've got from the spot market, we know the spot market is about ownership of what? Of an asset. So you buy an asset at point A, you expect the price to rise from point A to point B for you to generate your profits. So in this sense, you buy low and sell high. You buy low and sell high from point A to point B. And in that case, you own the assets. In the case of spot trading, the trader owns the assets. So you are owning the assets. But when it comes to the aspect of trading on the futures market, we said it's not ownership of an asset, but a contract market. At what? A contract market. And why do we say that the futures market is a contract market? So we will still be comparing the idea, the understanding, or the knowledge that we've got from the spot market so that we can expand this aspect of the lesson for you to get it clear. Right? Right. Good. Are you following? 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 Good. All right. So we said, unlike the spot market where we compare or where we say the market is based on what? It's based on ownership. The futures market, we said it's based on what? Contracts. So you agree on terms and conditions in the market, either to buy or to predict the price movement or the price of an asset to either rise or fall in value. So you are either predicting the price of the asset to rise or fall in value. That is the idea of the futures trading. And in the case of predicting the price to rise, we said you are either going on buy or long. And in a case where you are predicting the price of the asset to fall in value, in case where you are predicting the price to fall in value, we said you either go on short. Okay, when you are predicting the price or when you are anticipating the price to fall in value, you either sell or you go on short. Is that clear? Is that clear? Is that clear? Is that clear? Very good. So that is what we discussed in our previous session. And that is the main reason why we said the futures market is based on contract. In this case, after you coming here to trade, based on these contracts, you are either agreeing that the market is going to drop in value. And since it's going to drop in value, that is the reason why you are going on what? On short. That is the reason why you are going on short. You are going on short simply because you believe the price of the asset is going to do what? Is going to drop in value. And you are going on long because you believe the price of the asset is going to rise. Now, we all know that the market moves in two directions, or basically three, but mostly we see two directions of the market. Either it's an uptrend, downtrend, or sometimes sideways markets. But mostly we mostly analyze the markets from two dimension. That is either uptrend or downtrend. Either uptrend or what? Downtrend. In this case, when you realize the directions of the markets, if it is an uptrend market, that is when the trader intends to go on long. If it is on a downtrend market, that is when the trader starts to go on what? On short. That is the idea. Now, we also discussed that in terms of the futures market, for you to be able to understand the main reason why it is contracts, aside you going on long or short, there is what we call leverage. There is what we call leverage. So we discussed that when we talk of leverage is what makes the futures market to go on like what a contract, or to agree with what we call contract. Because with leveraging, leverage gives you the power or the strength to hedge your capital or to raise more capital. So in a case where a trader is having an assumed money of, let's say, $100, okay, in a case or in a situation where a trader is having, let's say, $100, and then he choose to go for 10x. Now, this simply means going for 10x simply means you are going for a leverage of 10 times with your capital, which is 10, 100 times 10, which will give us, sorry, 100 times 10. Another time 10 give us how much? 100 times 10. 100 multiplied by 10. What will be the answer? 100 multiplied by 10. What will be the answer? Write in the chat box. 100 multiplied by 10. 100 multiplied by 10. 100 multiplied by 10. What is going to be the answer? I only two people following the discussion. 100 multiplied by 10. What is going to be the answer? 100 multiplied by 10. What is going to be the answer? Good. 100 multiplied by 10. Very good. 100 multiplied by 10. Very good. So in this case, your leverage is going to be 1,000. Just like you are presenting in the chat box, it's going to be what? 1,000. This means you are no longer using $100 as your initial capital, but then as your position amount, but rather you are using $1,000. Take your time and follow this aspect. This means you are no longer using $100. Unlike the spot market, if you have $100, you are using the $100 to trade. If the market goes against you, it goes against you straightforward from the $100. In this case, that is the $100 becomes your total position amount. In the case of the futures market, since you are going for a leverage of 10, since you've chosen to go for a leverage of 10, it simply means you are using $1,000 as your position amount. You are using $1,000 as your what? As your position. In this case, let's look at something here. In this case of you using $1,000 to trade, in a case of using $1,000 to trade, now your capital is $1,000. When the markets move in favor of you plus one, you are making what? $10. If I'm right. In a case where the market move in favor of you, that is plus 1%, you are making $10. If I'm right. So in a case where the market is moving 1% in favor of you are making $1,000. Sorry, $100. So 1% of $1,000. 1% of $1,000. What is going to be 1% of $1,000? What is going to be 1% of $1,000? What is going to be 1% of $1,000? Any answer in the chat box? Any answer in the chat box? 1% of $1,000. 1% of $1,000. 1% of $1,000. 1% of $1,000. Good. That is $10, right? 1% of $1,000 is $10. Who's saying 108? 1% of $1,000. 1% of $1,000. Those saying 108, check your calculation well. So 1% of $1,000, that will give you what? That will give you $10. So in this case of you having $10 as your profit, this comes from the position amount. This simply means you are making 10% of your capital. Your capital was what? $100. Mind your capital, which becomes your margin, which we will go there. So once the market moves in favor of you, that is 1%, you are going to make 10% of your capital, which is $100. Are we learning? 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 Hello? Am I loud and clear on the line? Am I loud and clear on the line? Very, very good. Very good. Very good. Very good. So now let's look at it. Take your time. I want to take time to explain the leverage to you because I guess a lot of people have questions about the leverage. Now, what we are saying is that with the leverage gives you the power to trade based on your position what amount. So in a case where you have $100, I'm taking time to explain this. Follow. I'm taking time to explain this to you. Follow. We are not rushing this lesson at all. We are taking it slowly. So now this is it. You have $100. You go for or you went for a leverage of 10x. Okay. You went for a leverage of 10x. So with your $100, with a leverage of 10x, which simply means which is 100 times 10. 100 times what? 10. So in a case where you are trading with 100 times 10, which is your position amount becomes $1,000. Now, what we are saying is that if the market goes in favor of you, if the market goes in favor of you, that is plus one, you are making a profit of what? Of $10 because of your position amount, which is $1,000. This simply means that your capital, your margin, your initial capital, which was $100, you are making 10% of this amount. Is that clear? 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 Good. Very good. So in this case, you always need to understand your leverage. You always need to do what? Understand your leverage. In the same manner, if the market should go against you, in the same manner, if the market should go against you, that is minus one. That is minus one. If the market should go against you, minus one. Since the market goes in your favor plus one, and you make $10. If the market also goes against you minus one, you lose $10. you lose $10. If the market goes in favor of you, plus two, you make profit of what? $20. You make profit of what? $20. Now, in this case, if the market also goes against you plus minus two, you lose $20. Now, mind you, where from is the $20 deducted from this $1,000? Is the $20 deducted from this $1,000? Now, give me an answer in the chat for me to know if you are following. Is that $20 deducted from this $1,000? Is the 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 $20 deducted from this $1,000? Good. So in this case, the $20 will not be deducted from the $1,000 because the $1,000 is your leverage amount. The $1,000 is your what? Is your leverage amount. So the $20 will be deducted from your margin. So this leads us to another term. So now you've understood the leverage. Now you've understood the leverage. So when you are trading, you are going to see two things here. I'm going to take time to explain these terms to you. You are going to see things like position amounts. You are going to see things like position amounts. And then things like margin, initial margin. Follow this aspect very well. So you are going to see things like position amount and then margin. You are going to see these two things. So when you talk of the position amount is calculated based on your leverage. Okay, the position amount is calculated based on your leverage. So let's assume you have $5. You chose or you selected a leverage of 20x. Now I'm explaining this one to you. With 20x, that is 5 times 20. 5 times 20 will give us how much? 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 Good. That is going, we are going to get 100. We are going to get 100, right? We are going to get 100. So over here, when you come here, the 100 becomes your position amount. The 100 becomes your position what? Amount. While the 5 becomes your margin. While the 5 becomes your what? Your margin. So you are using $5 to open a position amount of what? Of $100. In this case, you want to leverage, you want to use $5 to leverage to raise more profits. Is that clear? Now, sometimes when we are explaining some of these features marketing, people find it to be so complicated. Let me calm down. Some of you, you've been borrowing money from the banks. True of us. You've been borrowing money from the banks. Now, the money that you go to borrow at the bank, listen to this. The money that you've been borrowing at the bank, they ask you to pay for initial deposits, or maybe you've saved money at the bank. Saving money at the bank, you need loan. So they are going to base on the loan on or your capital that you have at the bank to give you loan. Okay. Now you have $100 at the bank. They said, okay, based on this $100 that you have, we can give you $200. We can give you how much? $200. So with your capital plus the amount they are giving you $200. This simply means the $100 becomes your margin, and then the $200 becomes your position what? Amount. The $100 becomes your margin, the $200 becomes your position amount. So in a situation where you are the bank, you are using $100 as your margin, $200 as your what position amount. Is that clear? Is that clear? Is that clear? Are you following? Are we learning? Is that clear? You've understood the meaning of the position amount and then the leverage, the margin. Is that clear? Very good. Very good. Not clear. Okay. Someone is saying not clear to me. Okay. Now, what we are saying is that comparing the margin, all these futures trading that we've been doing, the replica of all these tradings happens in the bank. And we follow the trend of the bank every day. There are some people that are owing the bank. And it's because of the languages or the terms that maybe you may not understand. Getting the terms very clear, you realize that it's the same thing that happens at the bank. So the banks also trade futures. When I say the bank also trade futures, the banks use you as a future market. It's simple as that. In this case, you have money at the bank, or you want to go and borrow money at the bank. The bank says, okay, for you to borrow, for us to borrow you this money, we need a collateral from you. For us to borrow this money, we need a collateral from you. So, in the sense of you getting the collateral, they said pay some amount of money or use your savings as a form of what? Collateral. If not your savings, maybe your property as collateral. So, in the case of you using your property as collateral, your margin serves as your what? Your collateral. The money they are giving to you serves as your position amount. Is that clear? This is very simple. So the money they are giving to you at the bank serves as your what? Your position amount. The money you have at the bank serves as your margin or your collateral. So either you choose to call it margin or collateral. Is that clear? Is that clear? Very good. Very good. Very good. So now you understand the margin, you understand the margin, you understand your what? Your position amount. So when it comes to trading on the futures market, we said we are explaining the leverage to you for you to get it clear now. So in a case where you have $100 to trade in the market, in a case where you have $100 to trade in the market, now let's look at it. Let's look at it. So if you have $200, you choose to go for a leverage of 10x. With $200, you go for a leverage of 10x. This simply means you want to hedge or you want to trade with what? $2,000 as your position amount. Now, $200 is your margin. That is your collateral. When the market goes in your favor, 1%, that is plus one. When the market goes in favor of you plus one, you make how much? $20. That is plus one. This $20, which means you are making 10% of your capital, which means you are making 10% of $200. The same manner, when the market goes against you minus one, it simply means you are losing $20, which simply means the market is going against you 10% of your capital, which is $20. Because you are using this $200 as collateral, or this $200, which is your margin, is serving as your collateral. If there will be any need for liquidation, it's going to base on this capital, not this $2,000. Not this 2,000 what? $2,000. This $2,000 is to help you, it's to empower you. That is what we call it leverage. That is what we call it what? Leveraging or leverage. So what your little capital can't do, with the leveraging power, you can be able to do what? You can be able to do. That is the reason why we said in the futures markets, yes, there are losses, and the losses happen because the system or the exchange is borrowing you money to trade. The exchange is borrowing you money to trade. So the leverage gives you the borrowing power to do what? To trade. Is that clear? Are we learning? Are we learning? Are we learning? Good. Now let's move on. Let's move on. Now, in the case of our discussion, we said whilst you are using the bot to trade, when the market is going against you, what do you do? When the market is going against you, what do you do? So this comes to another thing that we discussed in our previous session. We said we are using two forms of margin here. We have isolated margin and then cross margin. Isolated margin and then cross margin. So over here in our case, we are going to discuss on isolated margin. In our case, we are going to discuss on cross margin. So we are discussing on cross margin. Now, what is cross margin? And mostly advanced traders uses what we call cross margin. That is the reason why Royalq gives you the opportunity to leverage on your markets or to leverage on the market uses cross margin. So we are using cross margin. We are using what? Cross margin. Now, when we talk of cross margin, one, it gives you the opportunity to leverage or marginalize your capital in the market. When I say marginalize your capital in the market, in the case of margin calls, you are free to go, unlike isolated margin. Now, when it comes to cross margin, let's assume I have $50 in the market. I have $50 in the market. I'm using $25 to trade. I have $50 in the market. I'm using $25 to trade. The market is going against me. Meanwhile, I'm very sure that this position I can win this market because the probability that the market can easily rise in my favor is very high. What do I do? When I have cross margin, I can choose to add up, or the market will add up for me based on the remaining capital out of this $50. So I've used 50, 25. I have 25 remaining. So if there is a need be for it to add up $10 in addition, the $10 will be added to this $25 to make it $35. To make it what? $35 to continue the trading. Now, when you are using isolated margin, once this $25 has been triggered and to hit liquidation, you will be exited out of the market without any permits. You will be exited out of the market without any permits. You will be exited out of the market without any permits. You can be exited out of the market without any what? Any permit. But in a case where you have cross margin, when you are using cross margin, so Royalq provides the trader opportunity to use cross margin. So we are not using isolated margin, we are using what? Cross margin. So with cross margin, you can open margin calls on your trade. So anytime the trade goes against you, it can buy new assets to leverage on the average prices. To leverage on the average prices. Now, another thing too that you are going to see on the futures market aside cross margin, we are not fully discussing about margin calls yet. We are not fully discussing margin calls. Now, another thing too that you are going to see on your futures trading is what we call liquidation price. It's what we call liquidation price. After setting up a trade, now you know your entry price and you know the mark price. I will explain these terms to you because after opening up the trade on Royalq, when you go into your exchange, you are going to see these things there. When you go into your exchange, you are going to see these things there. So once you open up the trade on Royalq, the trade will reflect in your exchange. And so far as the trade is reflecting your exchange, you will go there to see this trade there. Are we learning? Are we learning? Are we learning? Or I'm out? Are we learning? Am I loud and clear on the line? Good. Very good. Very good. Very good. Now we can proceed. Now we can proceed. Now you are going to see these three things there. You are going to see entry price, mark price, and then liquidation price. You are going to see these three things there. And after understanding these things, you would understand that trading using the boat is so secured, and you are always secured in the market too. Now, how why am I saying this? When you talk of the entry price, we could term the entry price as your average price or as your average price. So on Royalq, you will see average price. But when you go into your exchange, you will see entry. Okay. So Royalq, you will see average price, and then your exchange, you will see entry price. They are the same. Now, when you talk of the entry price, that is the price at which you enter the assets. And the same what the same term is what we call it the average price. The same term is what we call is what? The average price. So when you talk of the average price is the price at which you bought the asset. The actual or the original price at which you bought the asset is the what? Is the average price or the entry price. The entry price. Now you would also see mark price. You would also see mark price. When we talk of the mark price is the price at which the current market price of the asset, the current market price of the what? Of the asset. So if you're on long, you will see mark price. If you're on short, you will still see mark price. That is the current market price of the asset. So in your Royal Q, you are going to see current price. In your exchange, you are going to see mark price. Now, the next thing that I'll talk about, or I want to talk about, is your leverage price. Sorry, liquidation price. Liquidation price. And this is what makes it clear to you, the trader, whenever you are trading on the futures market. This is what makes it clear to you, the trader, whenever you are trading on the futures market. Now, when we talk of liquidation price. So take the time. I'm taking time to explain this aspect to you, the trader, for you to get it clear. Now, let's explain liquidation price. Now, you know your entry price, you know your liquidation price. So, in terms of entry price, mostly you know on the spot market, whenever you are trading, the entry price, when the signal is given, you either see current market price or preset price. So, these two may be your entry. Your entry may be in the form of current price or preset price. Now, aside that, let's talk about liquidation price. Anytime you set up a trade, for you to be liquidated, you can know when you will be when you can be liquidated out of the market. You can easily know, and that is the reason why you need margin calls, and that one will be discussed. So you now have your liquidation price. When you talk of liquidation price, now let's assume I'm on long. Okay. Now let me ask this question: if you are on long, the market goes against you in redirection. If you are on long, the market goes against you in redirection. If you are on long, the market goes against you in redirection. If you are on long, the market goes against you in redirection. If you are on long, the market goes against you in redirection. If you are on long, the market goes against you in redirection. Eh, this one, some are saying down, some are saying up. When we say long, we mean buy or long. So what we are asking is that if you are on long, the market goes against you in which direction? If you are on long, if I open position on long, the market goes against me in which direction? Very good. It's short. the market goes against me, it's not in an uptrend, please. It's not in an uptrend. It's not in an uptrend. We mean when we talk of long, we mean uptrend, and when we talk of short, we mean downtrend. So what we are asking is that if you are on an uptrend, if you are predicting the market to be on long or buy, the market goes against you on short. Are we learning? If you're on long, the market goes against you on what? On short. If you are on long, the market goes against you on short. It's very simple, right? Very good. Now let's go back. So I want to use this to explain the liquidation price to you. Now, when you set up a trade, let's assume you are on long. So let me use Solana as an example. So let's assume you are on Solana, you are on long on Solana. So long. The price of Solana is, let's say, 150. Okay, 150. And you are on long. This simply means you are predicting the rise of what? Of Solana. Now, being on long, let's assume this is your liquidation price, 140. This is, you see this amount there, 140. You see this amount there, that is 140. 140 becomes your liquidation amount. So they will set it for you. You are going to see it, 140. So in the case of you going on long and you are seeing this amount that is 140, this simply means when the market drops below 140, you'll be liquidated. This simply means when the market drops below 140, you'll be liquidated. That is the meaning of the liquidation price. That is the meaning of the what? Of the liquidation price. So if you set up a trade, always check your liquidation price. If you set up a trade, always check your liquidation price. And once you check the liquidation price, in our next session, we will learn on how to calculate for liquidation. We will learn on how to calculate for what? For liquidation. Now, in this case, when you have 140 as your liquidation price and your prediction is on high, so anytime the market is going against you, you are not worried until the market gets to within or closer to this barrier, which is 130, 139, 140 or below. That is when you get to realize that you are getting closer to what? To liquidation. That is when you get to realize that you are getting closer to what? To liquidation. So until you get closer to this 140, it's not possible for you to be liquidated. Until the asset or the trade fall below 140, it's not possible for you to get liquidated in the market. Is that clear? Are we learning? Are we learning? Are we learning? So someone is asking, is liquidation price constant? Now, liquidation price is based on first your leverage. Okay? Liquidation price is based on your leverage and then your margin. So if you keep opening margin call, the liquidation wouldn't be constant. But if there is no margin, more margin calls being open, the liquidation will be constant. The liquidation price will be what? Will be constant. So in a case where you are opening more margin calls, your liquidation price will keep changing because the average price wouldn't be the same. Okay, so I'm repeating or I'm going over the liquidation price. I'm going over the liquidation price. So now listen, listen to this. What we are saying is very simple. So we said let's assume you are on long. Okay, let's assume you are on long on Solana. The price of Solana is 150. The price of Solana is what? Is 150. Now you are on long. This simply means you are predicting the rise of Solana. This means anytime Solana drops in value, the market goes against you. Anytime the market drops in value, so if it drops from 150 to 149, the market goes against you. If it drops from 149 to 148, the market goes against you. From 148 to 145, the market goes against you. Is that clear? Is that clear? Is that clear? You are on long. Mind you, you are on long. Is that clear? Very good. Very good. Very good. Now, let's proceed. So in this case, what we are saying is that let's assume your liquidation amount Your liquidation amount is 140. Okay, or your liquidation price is 140. Your liquidation price is 140. Your liquidation price is 140. So since you have a liquidation price of 140, even if the market should drop below 150, 149, 148, 144, you are not yet going to be liquidated until it gets closer to this amount, which is 140, or until it reaches or it tends towards 140. Until the market drop to 140, that is when you can experience liquidation. That is when you can experience liquidation. So in this case, though we've not explained more on margin calls, I think in our last session we did that, but today we are not going to discuss more on that. So we are just explaining some of the things that you are going to see in the market. So in the case of you having your trade, for you to be liquidated, first target your liquidation price. If you know your liquidation price, you know when you how long you can stay in the market. If you know your liquidation price, you would know how long you stay in the market. If you know your liquidation price, you will know how long you can do what? You can stay in the market. Now, one thing that I've been saying is that when it comes to trading, risking is not about avoiding losses. That is one thing that you have to understand. To risk money is not about avoiding losses, but rather controlling how you do what you'll be able to survive long term in the market. So it's about controlling them. It's not about avoiding losses, but what controlling them. That is the reason why we have the idea of what trading more on the futures market too, in addition to the spot market. So it's not just about avoiding losses, but it's about controlling what losses in trading. When it comes to trading, it's not about avoiding losses. So risk taking is not about avoiding risks at all, but controlling risk. All right, good. So take your time. Okay. So I'm sure now you've understood the concept of the liquidation price. I'm sure now you've understood the concept of the liquidation price. Have you understood the concept of the liquidation price? Have you understood the concept of the liquidation price? I'm sure now you've understood the concept of the liquidation price. I'm sure now you've understood the concept of the liquidation price. Okay. Very good. Very good. Very good. Now we can proceed. Now we can proceed. Now we can proceed. Another thing too, that once you are trading on the futures market, you are going to see. Please, the lesson is very long and take your time. We are not rushing anywhere. Okay, we are working out. We are explaining things until you all get the concepts. You understand what you are doing. Trading is more about making an informed decision, understanding exactly what you are doing, because it is your money. It's not my money. Listen to this very carefully. You are trading with your money, and so far as you are trading with your money, it's your personal responsibility to understand the reason why you are making such decision. Do you get me? It is your personal responsibility to understand the reason why you are making such a decision. So that is the reason why we have to take time to explain things to you so that you understand why you are making such a decision. That's the reason we call it making an informed decision. So anytime we call you a trader, it simply means you understand what you are doing and you are making an informed decision with your money. Do you get it? Do you get it? Good. Very good. So now let's proceed. Very good. Now let's proceed. Now, the next thing that I will talk about, then I give you opportunity to ask your question. I'll give you the opportunity to ask your questions. When you are trading on the futures market, you are going to see what you call fund rating or fund rate. Fund rate. Now, this is not from Royalq, this is from Binance. Pay attention and listen to this. This is not from Royalq, this is from Binance or the exchange. This is not from Royalq, this is from the exchange. Pay attention and listen to this. And every single trader who trades on the futures market must know about what you call fund rate. Every trader who trades on the futures market must know about what you call fund rate. So, after understanding the basic concept, your margin, your leverage, your liquidation price, your mark price, your entry price, you would also need to know more about what? About fund rate. Now, when we talk of fund rate, what is it? It's very simple. And let me use some few seconds to explain fund rate, or a few minutes to explain fund rate to you. Then I'll give you the opportunity to ask questions. Okay. Now, this is very simple. Depend on the exchange you are using. And most of the exchanges have made it simple that every 8 hours, when you stay in the market for every 8 hours, you pay what you call fund rate. Fund rate. If you stay in the market for every 8 hours, you pay what we call fund rate. Now, who do you pay this fund rate for? Who do you pay this fund rate for? It's very simple. So long traders pay fund rate for short traders, and short traders also pay fund rates for long traders. I'm repeating. Short traders, when you talk of short traders, we mean those who are on short or predicting the drop of the market. If you stay in the market, if you are on short in the market for 8 hours, which simply means staying in the market for 8 hours simply means your prediction is failing, right? You are failing your prediction. You have not yet hit your prediction. So you pay a fund rate of 0.01, or sorry, 0.02%. 0.02% to the long traders. To the long traders. And in same manner, if you are on long for 8 hours, you pay 0.02% for short traders. So it's vice versa. So it's either you earn fund rates or you pay fund rates. And every trader who stays in the market will either receive fund rates or pay fund rates. This is not for the exchange. This is not for the exchange, but this is for the traders. This is for the traders in the market. This is for traders in the market. And one thing about the futures market is that that you need to know. Listen to this. The futures market is very simple. Which is very clear and you need to know in the futures market is that the liquidity that comes in the futures market is more or quite different as compared to the spot market. The liquidity that someone is saying we trade in for 1 week. Yes, it's normal in the market. You know, sometimes some of these fees, they are not fees that you easily see them. You get it? It's not fee that you easily see them, but we pay. So for you to stay, every futures trader pays for fund rates. Every futures trader pays for what? Fund rates. And it's common in the futures market. It's common in the what? In the futures market. But commonly, like I said, some exchanges and most of the exchanges apply the fund rate from 8 hours. After being in the market for what? 8 hours. After being in the market for what? 8 hours, you pay for fund rate. So every 8 hours in the market, you pay for fund rate. Every 8 hours in the market, you pay for fund rate. So if you are on long, if you have been in the market, or if you are on long, you pay fund rate for short traders. And if you are on short, you pay fund rate for long traders. This is very simple and there is nothing to complicate here. Trading the futures market is simple, it's not difficult. And I think they are just the terms, you need to be familiar with them, you need to understand how they work. And after understanding how they work, you can easily trade on the futures market and then generate your profit. And then generate your profits. Now, let me give you the opportunity to ask questions. Let me give you the opportunity to ask questions. Like I said, today's session is not going to be long. So, from our leader, if God permits, the future session is going to be on Wednesdays and then also Thursdays. So Wednesday morning and then Thursday evening. So you need to prepare for that. Wednesday morning and then Thursday evening. And we are going to consistently discuss more about this. So someone is asking, I was trading with um dollars using 20 times leverage. I got 500% and it's reflected P&L as 1%. How can you explain that? Okay, now this is very simple. This is very simple. When you come to futures trading, mind you, you are setting up the trade in your Royalq. You are not doing manual trading to be liquidated. Listen to this. You are not doing manual trading to be liquidated. So the profit margin is determined by your take profits. Don't forget this. The profit margin is determined by your take profits. So the profit you make is based on the take profit that you've set, either 2%, 1%, 5%, or whatever take profit that you set for yourself. So the profit that you are going to make will be based on the take profit, not how the market is reflecting, but your take profit. Yes, please take your time. You learn about the Julius will take us through how to use the indicators to short the market or long the market. So take your time. Like I said, we are not rushing the session. So how do you set MACD on short? So take your time. You go through that. Okay. So the next person, how can I switch to short to long when the trade is ongoing? Now, from our previous session, even though today I did not discuss that, from our previous session we said Royalq gives the trader the opportunity to hedge on the market. That was the term that I couldn't talk about today. Royalq gives the trader the opportunity to hedge on the market. So if you set up your account on hedge, if you're on long and the market is going against you, you can short it. You don't switch to short. Listen to this. You don't switch your trade to short, but you set up a position to short. So if you are positioned on long, if you are on a position on long, you open up a new position on short. If you're on a position on long, you open up a new position on what? On short. This is very simple. Hope you get it clear. Hope you get it clear. Very good. So must I pay the fund rate? No, 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 no. And what if I don't have balance? No, the fund rate is an automatic deduction that goes between long traders and then short traders, not from any actual funds or you are not the one who is supposed to pay that. It's an auto system that the exchange works it out. Yes, from the margin. You know, this some of these amounts are not huge amounts that you can easily see. Just assuming. So just look at it. Look at this amount. 0.02%. Just look at this amount. This will not even be up to a even 0.01 cents. Do you get it? This will not even be up to 0.01 cents of your capital. So it's not anything difficult. Please, what I'm saying is that this is not coming from Royalq. This is from the exchange. So far as you agree to trade on futures, these are some of the things you need to know. So far as you agree to trade on futures, these are some of the things you need to do. You need to know. You don't need to be ignorant of this. It is coming from the exchange, not Royalq. It is coming from the exchange. So far as whoever that is trading on or trading futures, that is what is being applied in the futures market. Just like applying leverage. Leverage is a general rule in trading on the futures market. It is not for someone trading on Royalq. Leverage is a general rule in trading. So there are some of the rules. Mind you, Royalq is the AI that is helping you to trade in the exchange. So every rule that is applied in the exchange exists. So look at this one. Oh. Look at this one. I put up $10 in my futures account before I wake up. Everything was gone and it didn't add up to my trade. I found out that the funding fee took everything. No, 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 it's not true. You've been liquidated, my dear. You've been liquidated. You've been liquidated. You've been liquidated. So Take your time and follow the lesson. Some of you, even signals have not been given. Who has given signals here? No one has given signals here. So if you get liquidated, you need to ask yourself, right? The Julius has not given signals, neither me. Crypto ambassadors have not given any signals. So if you get liquidated, you need to blame yourself because we've asked you to wait. Follow the session. When you are done with the session, signals will be given. So I can't trade without leverage. Can't I trade without leverage? Well, so we have what we call, maybe you are using 1x. So definitely you can trade without leverage. And going without leverage simply means you are going on what? 1x. And I think maybe in our next session we will discuss that. All right. Okay, so on my Binance features is over 100 times. Explain, please explain this. 100x. Now, I think if you have followed this session, go to YouTube and start from the beginning. We've discussed that. I told you earlier on that as a trader, you need to know your taste of value in the market. And Royalq, as an AI agent, help traders to minimize losses and maximize profits. Take notice of this term that I'm using. Royalq, the purpose of Royalq is to help traders minimize losses and maximize profits. I said Royalq is helping traders to do what? To minimize losses and maximize profits. So you are minimizing your losses and then maximizing what? Profits. So Royalq gives traders a highest leverage of 20x. The highest leverage that you can use in Royalq is 20x. This is the highest leverage you can use in your trading. That is 20x. And this is a fair value. Someone wants to say fair value gap, but I'm not going to use fair value gap. Okay. So this is fair game here. To maintain your profit margin and then also your losses margin. The highest that you can use here is 20x in Royalq, and it's fair. Over here, please don't go and use 20x. Don't go and use 20x. At most, if you use leverage, go for 5x. And whilst we keep learning, like I said, we are not rushing the lesson. Whilst you keep learning, we will discuss on margin calls. And after discussing on margin calls, we will also discuss on what we call RRR. That is risk to reward ratio. Risk to reward ratio. And once you understand risk to reward ratio, you will know that you don't need huge leverage. If you really want to balance your risk to reward ratio margin, you will need a lower leverage with good capital, then you are free to go. So in this case, at most, if you go 2x to 5x is okay for you to trade. 2x to 5x is okay for you to trade and balance your profit margin. 2x to 5x is okay for you. Hope that is clear. So at most, go for 5x. So if you see 100x in your exchange, of course, the exchange provides, some exchanges even provide 200x. So don't be surprised. Some of the exchange provide even 200x. So don't be surprised. So please, can we get a recorded version of this session? Okay, so I'm sure this session was recorded. Did okay, I have to check. Okay, so it will be sent to you on the platform. Trading in a short position as the robot was opening more margin calls, the liquidation price was rather coming closer. Why? Then you have to check how you open up your margin calls, because the idea of the margin calls is to help you hiding your liquidation amounts. Okay, the idea of the margin calls is to help you widen your liquidation amounts or liquidation price. So it's very clear. Who is this? Please, we are trading using Royalq. We are not going on option trade or IQ options. We are not going on IQ options. We are trading using Royalq. Okay, so follow the rule. If you want to be safe in trading, if you want to be safe in trading, it's not about just rushing to do things. Be ready to follow mentorship. Be ready to follow your leaders. Whatever instruction, the guideline they are willing to give you, be ready to follow that, and you make the money you need to make. Some of you rush too much. Take your time and follow the lesson. And once you understand what you are supposed to do, you'll be making the profits overdose. You'll be making the profits overdose. Eh? Good. All right. So someone is asking, how is liquidation determined? How is liquidation determined? Like I said, maybe in advanced session, you continue to learn on liquidation. And for liquidation to be determined, first message will be sent to the trader. Message will be sent to you either through your email or SMS. That is the first thing. That is the first thing. Message will be sent to you through your email. Or sometimes too, if you have an opportunity to check your trade, you can see it based on your liquidation price. You can see that based on your liquidation price. Or for you to get near to liquidation, message will be sent to you before your liquidation is being triggered. So people are running faster than their shadow. Yes, it's true. Some people are running faster than their what? Their shadow. They don't have the spirit of waiting. They don't have the spirit of waiting. You see, you run away, you think trading on the spot market is difficult. Over here, if you rush over here, the amazing thing here is that if you rush here, you use your money to pay for you rushing. If you rush here, you will pay for rushing. So you need to exercise patience and follow mentorship. That is what is going to help you. Don't rush. Don't do it. Don't rush. That is it. All right. So guys, if you have any question, you can write in the chat box or raise your hand for you to ask your question. Other than that, our time is up. Yes, we need to tell you. So if you have any question, you can write in the chat box. So I was trading in a short position as the robot was opening margin call. Like I said, you have to check your how you open your trade. Over here, like I said, if you open up a trade with a margin calls, the purpose of the margin calls is to create new average prices. Though I've not discussed on margin calls yet, so I will not talk much on that. But the purpose of the margin calls is to create new average prices. And the more you create new average prices, the more you also create what? New liquidation price. So your liquidation price would also be what? Be different. All right. So guys, I think this is where time will permit us to end. Someone is asking, set one coin, please. We are not going to do that. When it's time for us to set up a trade, we will do. Like he said, some of you are rushing or running faster than your shadow. You are rushing or running faster than your what? Than your shadow. So where can we check your liquidation price? Okay. When you said opening a new short, it is with new capital. Yes, it is. It is with new capital. So opening position simply means you're opening up a new trade. So you have to understand that. Some people are ready to crash. Yes. But leave them. If they die, if they die and they are not able to resurrect, they will see. If they die and they are not able to resurrect again, they will see. All right. So guys, I think this is where time will permit us to end this evening session. We will still meet again. We will still meet again. So someone explain more on long and short position. Explain more on long and short positions. Explain more on long and short position. So I'll use some few minutes to explain this. Now we said when we talk of long, even this one I don't need to write anything. Now we said when we talk of long, long simply means predicting on the price value to rise. And short simply means that is the simplest understanding every layman should know. And if you get to understand this, you are free. You don't need to complicate anything for yourself. Okay. So what we are saying is that when you talk of long, it's about predicting the price direction to rise. And when we talk of short, prediction the price direction to do or to fall. That is the meaning of long and short. Hope it's clear. So prediction on the price direction to rise or prediction on the price direction to fall. That is the meaning of long and short. Okay, so I asked before, can I determine the contract when I see that I'm in profits? Can I terminate? Yes, you can. Just like on sports trading, you see, this is just a transfer of knowledge. This is just a transfer of what? Of knowledge. So when you are trading, sometimes in the sports market, you realize that you are in profit. You go to Royalq, you close your trade, right? So you choose to close the trade manually, or you leave the your TP to be triggered automatic. This is simple. Okay. So I think that is all for this evening. We'll still meet again, and every necessary update will be given on the platform. So it's almost late. It's 9:12 in Uganda, 7:12 in Ghana, and 8:12 in Nigeria. All right, so guys, thank you all for being with us this evening. Thank you for your time and thank you for learning with us. We shall still meet again. Have a wonderful good night. Love you all. Bye bye bye.